The silver price you are seeing is real, but the price you are being offered is a different market entirely. And that gap is where the real story lives. Because there's a force working overtime to keep this move feeling ordinary. Not by magic, by structure, by spreads, by risk desks, by the quiet math that decides what a dealer can pay you without getting trapped. And before we're done, you'll have a clean, concrete checklist for what to watch this week, what level matters, what breaks if it fails, and the exact conditions that make dealers suddenly go from lowballing you to chasing your metal. You walk in with 40 ounces. It's not a hypothetical. You've got weight in your hand. You've got a mental anchor to spot. And you're expecting a clean, professional offer that lines up with the chart you've been watching. You're not trying to win. You're just trying to transact. And then the dealer looks at you, maybe not even rude, just matter of fact, and the number they quote feels like it came from a different universe. On that moment hits a nerve. Not because you can't do math, but because it exposes the part of the silver market most people never have to see until they re-standing at a counter holding actual metal. And then comes the line, the sentence that sounds like a brush off, but is actually a window into how the market really clears. Something like, we can't pay spot on that right now, or that's not spot, or if you want spot, you sell paper. It stings. It also tells you the truth. Here, it's the first thing to lock in. When a dealer says that Wes, not spot, they're not trying to insult your intelligence. They're pricing your metal off their risk, not your screen. Dealers don't run a charity, but they also don't run a conspiracy. They run a spread business. They run inventory. They run replacement. They run the very unglamorous reality of, if I buy this from you at X, can I replace it, hedge it, and sell it without losing my shirt if the market whips? And that's where the pressure starts. Because the headline silver price is a single number that reflects the most liquid slice of the market, often futures or tightly linked derivatives. Your physical bar is not that instrument. Your 40 ounces is not a ticker symbol. It's a logistics object with a bid that depends on who wants it, what form it's in, how fast it can move, and what the dealer has to do to not become the bag holder if the market gaps against them overnight. So the key question isn't, why are dealers ripping me off? The key question is, what changed in the plumbing that makes the dealer's bid detach from spot? And here asks the hidden detail that reframes everything. Dealers are not anchored to the headline price. They're anchored to their ability to replace, hedge, and unload inventory without getting trapped in a timing mismatch. That's it. That's the whole game. If replacement is smooth and hedging is clean, bids tighten and offers rise. If replacement is messy and hedging carries basis risk, bids widen and spot becomes a suggestion instead of a promise. But that's not the part that matters most. The part that matters is what's forcing that messiness right now and why it shows up at the exact moment you try to sell. Because in silver, there are two markets running side by side that only pretend to be one market when conditions are calm. Paper trades in milliseconds. Physical moves at the speed of fabrication, shipping, settlement, and somebody else's cash register. Paper can print a price with a keystroke. Physical has to clear through real constraints, refining capacity, product form, wholesale availability, retail demand, and the simple fact that metal doesn't teleport. So when you hear spot, don't think truth, think reference. It's a reference price for a particular kind of liquidity, and when that liquidity is fighting with physical conditions, the tension leaks out through one thing that almost nobody watches closely enough, the spread. If you want the real signal, don't stare at the price, watch the spreads, because spreads are where stress confesses. Bid-ask spreads, wholesale retail spreads, futures term structure. Local premiums, the boring stuff, the stuff that tells you whether price discovery is clean or fractured, because when the market is healthy, spreads behave. When the market is stressed, spreads scream. The next detail is what flips the whole setup. And let's talk about the street reality you just experienced, and then we'll connect it to the mechanics. A dealer quote is not a proclamation of what silver is worth. It's a risk-managed bid that includes a bunch of invisible costs. Their overhead, their margin, their expected time to resell, their expected ability to restock, and, this is huge, their ability to hedge the exposure they just took on. Here's why that hedging piece matters. If a dealer buys 40 ounces from you and silver drops hard before they resell it, they eat that loss unless they hedged. In theory, they can hedge with futures. In practice, that hedge isn't always perfect, because your bar is a specific physical form, and the hedge instrument is a standardized financial contract. That mismatch creates basis risk. And when basis risk is elevated, when spreads are unstable, when physical premiums are moving, when liquidity is thin, dealers protect themselves the way any sane risk manager would. They widen the spread, they lower bids, they pay less than spot, because spot is not the market they are actually forced to clear in. And if this one level breaks, the math changes. Now, why would basis risk spike right now? This is where the calendar becomes the catalyst. Silver has rhythms, not mystical rhythms, institutional rhythms, month end, quarter end, option expiry, delivery windows, times when positioning rolls, times when hedges get reset, times when liquidity thins out, especially around weekends or holiday-like conditions, when a move can travel farther than it should because there is simply less depth on the other side. Into these windows, dealers get more defensive for a simple reason. Gap risk becomes real. If silver can open $1 lower on a Sunday night futures session, or rips higher in a thin liquidity burst, the dealer who paid you a tight bid on Friday can wake up Monday holding inventory that instantly mispriced relative to their ability to offload it. So they preemptively protect themselves. They don't need to believe anything. They just need to survive. That's the conflict. You think you're selling into a single unified market. They know they operating at the intersection of two markets that only align when stress is low. Now let's make this painfully concrete. Imagine silver is trading at a headline price. You walk in expecting something close to it. The dealer is thinking, what's my replacement cost if my wholesaler is tight? What's my sell-through time if retail demand is dead this week? What's my hedge cost if futures spreads are unstable? What's my risk if physical premiums are compressing? And what happens if I buy this and the market whips, forcing me to mark down inventory to move it? That last part is important. Dealers don't just price metal, they price the probability of needing to liquidate metal fast. And this is where price becomes a liar and the spread tells the truth. When the market is calm, the difference between buying and selling feels small and fair. When the market is stressed, the spread widens like a mouth opening. Dealers are not doing that because they're greedy in a vacuum. They're doing it because their risk inputs just got worse. They're staring at the same world you are, but through a different lens. Replacement, hedging, velocity, and inventory. Now let's go deeper into the piece that confuses almost everyone. Inventories. People love to talk about inventory like it's one pile of metal sitting in one place, ready to be delivered on demand. That's not how it works. Inventory has categories. Some inventory is deliverable into certain systems. Some is just stored. Some is spoken for. Some is in the wrong form. Some is sitting in a warehouse, but not available to relieve immediate stress without conversion, time, and cost. So when you hear that inventories are fine, you should immediately ask, fine for what? Fine for paper settlement? Fine for industrial demand? Fine for retail products? Fine for delivery constraints? Because not all inventory is the same, and in the warehouse doesn't mean available to stop a squeeze. But that's not the part that matters. The part that matters is what happens near delivery windows and how that changes incentives. When the calendar puts pressure on deliverability, when participants need to roll, settle, or stand for delivery, paper and physical can decouple, not forever, but long enough to create the kind of weirdness you felt at the counter, long enough for dealers to say, yeah, that chart price is nice, but my real clearing price is different today. Now, let's stack proof the way a skeptical audience demands. Not one argument, 5 or 6. Mechanism, symptom, institutional behavior, supply chain friction, cross-market comparison, and then the forecast. First proof point, retail premiums and availability. If you've been around metals long enough, you've seen this. The chart chops or even drops, but the premium you pay for certain products stays stubborn. Sometimes it even rises. That's not random, that's physical tightness showing through. It means the real price for a product in the real world is being supported by scarcity, fabrication constraints, or demand that's not letting go. And when premium stays stubborn while the tape looks messy, that's the street telling you supply is tighter than the headline suggests. Second proof point, dealer bid behavior itself. If multiple dealers are widening spreads at the same time, lowering buy bids while keeping sell prices sticky, that's a sign they truly protecting themselves from volatility and replacement uncertainty. If they were simply ripping people off, you'd see competition force bids up immediately. Dealers compete. They want flow. When they all get defensive together, something upstream changed. Third proof point, term structure and spreads in the paper market. Futures aren't just a price, they're a curve. When the front end gets tight relative to later months, when backwardation pressures show up or spreads behave unusually, it can signal immediate demand or supply constraint relative to later availability. You don't need perfect numbers to watch the behavior. You watch whether near-term pricing is being bid aggressively or whether the curve is paying you to hold time. That tells you whether the market is relaxed or stressed in the near term. Fourth proof point, cross-market comparisons. Silver is global. If you see persistent differences between regions, different premiums, different availability, different local demand signals, it tells you arbitrage is either flowing or blocked. And when arbitrage is blocked, price can become sticky in one place and cheap on a screen somewhere else, because the bridge between them isn't frictionless. Shipping, taxes, fabrication, and regulation can all make the bridge expensive. If that bridge is expensive, the market fragments. Fragmented markets produce the exact kind of "this isn't spot" experience you just had. Fifth proof point, industrial demand and procurement behavior. Silver isn't just a monetary metal story. It's also an industrial metal with real end users who don't care about your narrative. They care about securing input. When procurement teams get nervous about lead times or supply reliability, they don't wait for perfect prices. They lock supply. They sign contracts. They pull forward demand. That doesn't always show up as a clean, polite rally on the chart. Sometimes it shows up as persistent tightness in physical channels and stubborn premiums. The next detail is what flips the whole setup. Industrial demand can make a dip in paper feel like a mirage in physical. Sixth proof point, institutional behavior. Even if you don't have a perfect window into every flow, you can infer behavior from how price responds to stress. If dips get bought quickly, if certain levels act like magnets, if volatility spikes but price refuses to die, it can indicate that someone is using weakness to build exposure. Sometimes it's systematic, sometimes it's discretionary, sometimes it's hedging, but behavior leaves footprints. Now let S bring in the mechanism explainer that ties this together without turning into a textbook. Options, reflexivity. Because sometimes the move in silver isn't emotion, it's math. Here's the simple version. Options create a situation where dealers and market makers who sell those options often hedge their risk by buying or selling the underlying as price moves. If price rises and call options become more in the money, the hedger may need to buy more of the underlying to stay neutral. That buying can push price higher, which then requires more buying. That's a feedback loop. If price falls and puts gain sensitivity, hedgers may sell, pushing price lower, creating more hedging sell pressure. Another feedback loop. You don't need to memorize the Greek letters to understand the human reality. Options positioning can force mechanical buying or selling at the worst possible time. And if the market approaches a key strike area, especially into option expiry, the hedging flows can either pin price or slingshot it. That's why certain levels matter more than your favorite moving average. That's why you can get days where silver feels held down, and then suddenly it isn't. It's not always a villain. It's often positioning and hedging mechanics doing exactly what they're designed to do. Because if this one level breaks, the math changes. Now translate that into your dealer experience. If the dealer thinks the market is sitting near an options inflected zone where a small move could trigger a big hedging cascade, they will widen their bid. Not because they know the future, because they know the distribution of outcomes got fatter tails. They know volatility risk is real, and dealers hate fat tails. They don't get paid to be heroes. They get paid to manage risk and keep the lights on. So when the dealer tells you this, what they're really saying is, I can T-replace or hedge this cleanly right now. So I'm pricing your bar like a risk event. Oh, ice. And that's where people get emotionally hijacked. Because the human brain hears less than spot and translates it into, I am getting robbed, which then turns into either revenge trading or panic selling or freezing up. That's exactly how volatility uses you. It forces you to make decisions in the worst possible emotional state, under the illusion of urgency. So here's the viewer psychology shield, because if you're in silver, you need it. Volatility will try to make you trade your time horizon. That's the trick. It's going to show you a sharp move, then a violent reversal, then a headline that sounds like certainty, then another headline that contradicts it. And in the middle of that noise, you'll feel the impulse to do something. That impulse is expensive. The discipline is this: separate trend signals from noise. Trend signals are structural: spreads, term structure behavior, persistent premium behavior, repeated defensive key levels, and calendar-driven positioning. Noise is the daily drama that makes you feel smart for reacting fast. Price can whip around violently even if the thesis is correct. That's not a disclaimer. That's a feature of how this market shakes out weak hands and forces hedges. But that's not the part that matters. What matters is, what do you watch next, right now, to know whether the dealer discount environment is about to reverse? Here's the checklist. In plain language, the kind you can actually use this week. First, watch whether physical premiums stay firm or soften while the chart moves. If spot dips but premiums don't budge, that's underlying tightness. If spot rises and premiums explode, that's stress turning acute. If premiums collapse while spot is flat, that can indicate demand cooling or product flooding. Useful information either way. Second, watch dealer behavior as a signal, not as a moral verdict. Are buy bids improving across shops? Are spreads tightening? Are they suddenly willing to, quote, closer to spot for certain forms? That often changes before the chart gives you comfort, because dealers feel the flow and replacement conditions in real time. Third, watch the calendar. This matters more than people want to admit. Into month end, quarter end, option expiry, and delivery windows, the market's behavior changes, liquidity thins, rolls happen, hedges reset. This is when squeezes happen and when fake-outs hurt the most. The calendar is not superstition. It's the schedule of forced behavior. Fourth, watch the curve and the feel of near-term pricing versus later. When near-term stress rises, you'll often see it expressed as unusual urgency in the front end. Again, you don't need perfect numbers. You need to watch for consistent behavior. Does the near term act tight relative to later, or does the market pay you to wait? Fifth, watch cross-market friction. If you're hearing that certain products are scarce, that delivery times are extending, that certain regions are paying more, that refiners are backed up, those are physical world signals that can persist, even if paper tries to fake calm. Physical signals are slower, but they're stubborn. Sixth, watch key levels on the chart as triggers for forced behavior, not as magical lines. You're looking for areas where a break changes the incentive set. A break can trigger stops. It can trigger hedging flows. It can trigger short covering. It can change how dealers quote because their risk models change. When the market is coiled, levels are not aesthetics. They're tripwires. Now let ES put this into a two-scenario lens so you don't get trapped by one narrative. Scenario 1 is the controlled pullback and retest. In this scenario, silver pulls back toward a well-watched support area, volatility spikes, headlines get loud, and the market tests whether buyers are real. This is where you often see the best information. Does physical hold up? Do premiums stay firm? Do dips get bought quickly? Do spreads tighten back after the shakeout? If yes, the pullback becomes confirmation, not failure. If no, if support breaks cleanly, premiums soften, and the curve relaxes, then the market is telling you the move needs more time or the demand impulse is fading. Scenario 2 is the continuation squeeze and gap risk. In this scenario, the market doesn't politely retest. It pushes through a key level, liquidity thins, and hedging flows become fuel. Dealers may lag at first because they read offensive, then suddenly bids jump because they realize replacement risk has flipped. That's when the phrase "can't keep it in stock" starts showing up. That's when the spread starts doing weird things. That's when you get the emotional roller coaster, a fast rip, a scary pullback, then another rip. In that environment, you don't get to feel ready. You either have a plan or you get emotionally tossed. Because if this one level breaks, the math changes. Now, what would weaken or invalidate the physical stress story? Let ES say you see sustained softening in premiums and availability improves across the board, while spot fails to hold key supports. Let's say the curve relaxes and near-term urgency disappears. Let's say cross-market spreads compress and the market stops acting fragmented. That doesn't mean silver is dead, but it would weaken the thesis that physical tightness is vetoing paper pricing right now. What would confirm the thesis? Persistent premium firmness, defensive dealer behavior that suddenly flips to aggressive restocking, a curve that signals near-term tightness, dips that get bought quickly, and key levels holding or breaking upward with follow-through, especially around calendar triggers. And here's the payoff I promised. The moment you all know the dealer experience is about to change is when replacement fear flips direction. When dealers fear being short metal more than they fear holding metal, bids rise fast. You'll feel it. The same shop that acted like your bar was a nuisance suddenly treats it like a solution. That's the hidden mechanism, again in a single line. Dealer bids are governed by replacement fear and hedging cleanliness, not by your feelings about spot. So what do you do with that? You stop asking, why won't they pay spot? And you start asking, what is the market forcing them to do this week? And because the market forces behavior. It forces hedges. It forces rolls. It forces margin decisions. It forces inventories to move. It forces the truth out through spreads. And once you see it, you can't unsee it. Now let US address the skeptical crowd, the people who hear any talk of suppression and immediately roll their eyes. Fair. You don't need cartoon conspiracies to explain why silver can feel capped or mispriced. Incentives are enough. The paper market is deep and fast. Large participants manage risk with derivatives. Dealers hedge with standardized contracts. Funds rebalance around calendar dates. Options positioning can pin or whip price. And when volatility spikes, risk managers reduce exposure, which can create temporary downward pressure that has nothing to do with physical fundamentals. That's not a plot. That's how risk systems behave. At the same time, it is also true that physical markets can resist paper narratives for longer than people expect when supply chains are tight and demand is sticky. That resistance shows up in premiums, availability, and regional differences. Again, no magic, just friction. This is why silver is such a psychological battlefield. It's volatile enough to humiliate certainty. It's liquid enough to be gamed structurally. And it's physically constrained enough to occasionally snap back in violent ways, which means the only way to survive it is to be mechanism first. When the next red candle hits, the market will try to sell you a story. It's over. When the next green candle hits, the market will try to sell you a story. You're late. Both stories are designed to make you emotional. The antidote is the checklist. The antidote is knowing what actually drives bids and spreads. So here's how you keep your head. Decide what you're actually doing. Are you trading a move? Are you building a position? Are you holding metal as an insurance asset? Those are different games with different rules. The market loves nothing more than someone who is emotionally switching games midstream. That person becomes liquidity for someone else. And that's where the real pressure starts. Now let's tie it back to your 40 ounces, because this is the lived reality. You didn't just learn a theory. You touched the seam between paper and physical. You discovered that spot is a reference, not a guarantee. You discovered that a dealer's bid is a risk quote, not a judgment. And you discovered that when the system is under stress, the difference between screen price and street price becomes visible. That visibility is valuable if you use it. If you're watching this as a retail investor with a macro brain, here's the identity shift. Stop trying to be right about headlines and start trying to be early about mechanisms. You don't need to predict every tick. You need to know what forces participants to act and when. This week, watch the calendar triggers. Watch whether liquidity is thinning. Watch whether spreads are behaving or screaming. Watch whether physical premiums confirm or contradict the tape. Watch how dealers treat replacement. And watch the key levels that can flip positioning from managed to forced. Because when silver goes from managed to forced, it doesn't move politely. It moves like a door coming off its hinges. If you want to be part of a community that doesn't get emotionally farmed by volatility, people who care about plumbing, not propaganda, stay close, not because you need a guru, because you need a framework. And frameworks beat feelings in this market. Next week, the market is going to offer you a choice: react to the screen or track the structure. Reacting is easy, tracking is profitable over time, and if you do nothing else after this video, do this one thing. The next time you hear, "That's not spot," translate it instantly into "replacement and hedge conditions are stressed," and then go check your signals. Because the price can lie for a while, but the spread tells the truth.